Hello and welcome to Real Estate After Death. Today, we are going to be talking about such a big, important topic that I cannot wait to introduce it. But first, I wanted to introduce you to my lawyer. How are you, Raluca?
Hi, Shanice. Thank you for having me. I'm good. Thank you.
It's my pleasure to have you here. Will you tell me, what do you do?
My name is Raluca Soika, and I'm the principal of RMS Estates Law. And I practice wills and estates and real estate law in the Greater Toronto area.
Incredible. We have been doing this real estate after death for a little bit now. And basically, what it's all about is everything you should know about wills and estate planning and probate. So, today we have an incredibly big question and a big topic. So, with no further ado, we're going to be talking about if there's a way to reduce state administration tax. And if so, what is it?
So there's a couple ways to reduce this tax when someone passes away. This is actually a big part of the estate planning discussion that I have with my clients when they come to me. So one really popular way is to own assets in joint ownership. So spouses owning accounts or property in joint ownership. The survivor gets the property by right of survivorship, and it doesn't pass through the estate, and therefore it doesn't get tabulated under the assets that are subject to estate administration tax. So that's a big one, but it's not for everyone because I have clients asking me to add their child as to their account or to the title to the property, and it's not always appropriate because then the parent loses some of the control or that they have over that asset. So if in an account, on a bank account, if a child is joint owner, they have access to all of the parents funds that are in there. So unless the parent really intends to give this to their child, and is okay with losing control and doesn't need those funds to support themselves in any way, then sure, add the child as joint tenant, and we can evidence their the parents a wish that the child is the beneficiary. We can evidence that in the will or in a separate affidavit, and then it passes to the child without a problem, and there's no estate administration tax payable. But other than that, I don't always recommend that clients add someone to title just because they want this person to bypass estate administration tax. Another way is to name beneficiaries. So beneficiaries can be named on any registered account. That would be RSPs, TFSAs, for example, RIFs. They can be named on some pension accounts. Not all pension accounts allow you to name beneficiaries, and they can be named for life insurance as well. So all of these things where there's a beneficiary named with a financial institution, the asset flows outside of the assets that are counted in the estate for estate administration tax purposes. And in this case, by all means, if it's for example a life insurance, I would totally recommend that if the spouse has passed away and the parent just has children alive, I would totally recommend that they name their children as beneficiaries to this life insurance. It's not an asset the parent uses during their lifetime, and obviously they're just keeping it there for the benefit of their beneficiaries, really. But if it's a bank account, or oh sorry, if it's an RSP, yeah, they can do that too. They can name beneficiaries because beneficiaries named with a financial institution, they don't get access to the asset in the same way that a joint owner does. So wherever you can name beneficiaries, go ahead and name them. There are some situations where I don't recommend, for example, where they want their children to be beneficiaries and the children are minor. And
Mm.
what, minors are just going to get $1 million? How is that going to fly? They can name a trustee, can be named in certain situations, but that comes with its own host of pros and cons. And it's up to the clients to decide. This can trigger the involvement of the office of the children's lawyer. So it doesn't come without baggage. Um, and also where there's a beneficiary that's maybe spendthrift, they have creditor problems,
Mhm.
them receiving $500,000, they'll just go and spend it right away, may not be the best way. The parent may want a trust for them in the will with certain conditions, etc. So that's the deal with naming beneficiaries as with naming people as designated beneficiaries on these accounts.
While we're on beneficiaries, if you're named a beneficiary, is there any ramification or taxation down the road to that person? Like, let's say you're a beneficiary, you get a house, the house is sold, so you get the proceeds from the house. Later on down the road, let's say you even die, like there could be a timeline to this. Are you double taxed for that gift? Or it's just, it doesn't receive taxation?
So it generally no. You can't really be the beneficiary of a house in that way that I just spoke about, like by being named a beneficiary. You can only receive a house through a testamentary disposition, like a will,
Okay.
or if the person passed away without a will and you happen to be the beneficiary or part beneficiary of the house through intestacy laws. Um, for accounts, or like for example, registered account, TFSAs, life insurance, pension, the beneficiary doesn't pay any tax.
Okay.
So Ontario doesn't have tax on the beneficiary. The onus is on the estate. But there could be capital gains, like for
Mhm.
example, if there's any kind of investments that are in the RSP and there's capital gains, the state needs to service all of those taxes. But the beneficiary doesn't need to pay any taxes on their gift. That's generally how it works. And with respect to real estate property, it depends. If how the it depends on how the property was held by the deceased. Was it held as a primary residence? Was it held as an investment property? If it was held as an investment property, there may have been some capital gains. Um, Also, there could be a little bit of capital gains accumulated from the date of death to the date of selling or the property or the date of change of title. So those need to be serviced by the estate as well.
Got
Um, I can't think of any taxes that would kind of follow the beneficiary around. I think it's more related to what they then decide to do with that money, or with the property, and if their decision impacts, their own is impacted by their own personal tax situation. And I always recommend that they speak to a tax accountant and an investment advisor at that point in time to see how what's the best way for them to invest that money or keep that property going forward.
it.
So,
Gifted.
yes, so gifting a property during one's lifetime, um, people can do, parents mostly choose to do that. It's very popular for parents. For example, their spouse has passed away, they're not going to remarry, or even if they're going to remarry, they're in fact going choosing this on purpose to pass a certain property to their children, because then they know for sure that their children get the property. So it's with pros and cons. It's not for everyone. I would say that in case of real estate property, it's appropriate where it's not the primary residence of the person, of the parent, or the person that wants to gift it. They're not relying on the money that's maybe flowing out of this asset in any way. And really, there's very little impact on their life by giving this asset away. So in that case, if it makes a lot more sense for them to gift it during their lifetime, because there's quite a bit of estate administration tax saved by gifting it during their lifetime, then by all means, I'm happy to assist them to do this transfer. But where, for example, it's the parents or the person's primary residence, and they may choose to sell it in the future and downsize, and then rely on the money from the difference. Then I wouldn't suggest that they add a child to title or gifted to another person because they lose control of what happens to that property. That's it. That's the bottom line. And a lot of people don't realize that, and don't realize that this is a really big risk to take. And as much as they trust their child can get married, they can start having creditor problems, they can start having family law problems that is out of their will, but nonetheless affects the property anyway. So there's all these ramifications that I talk to my clients about before they make this decision, which is a really big decision to make.
Absolutely. Real life can definitely happen, and you don't foresee it or understand the legality that connects everyone and everything. But that's a really good point. Thank you for bringing that up.
Yeah, and there's another way I would briefly like to touch on, which is using a multiple will strategy to reduce estate administration tax. So multiple wills can be used where a person owns a business and they can they're it's not publicly listed on a stock exchange, so they can pass those shares through what we call a secondary will. They can pass, if they have, for example, expensive art, jewelry, cars. Those are all considered personal items, and they can be passed through a secondary will as well. Um, a certain real estate property can be passed through a secondary will as well. I'm not going to get into the details of that because it's a very narrow exception. But so there's all these assets that can be, they are quite high ticket items
Yeah.
that can be passed through a secondary will, and there's significant estate administration tax payable. But really briefly to explain the multiple will strategy, is multiple will strategy is where someone prepares two wills at the same time. They operate concurrently, and they're called a primary will and a secondary will. And the primary will is prepared to host any assets that have to be subject to probate, to estate administration tax. And the secondary will hosts assets, any assets that can be put into it, that can bypass estate administration tax. So that way you split your estate into two. It's perfectly legal to do, perfectly acceptable estate planning method. You split your estate into two, and you put as little assets as possible in the primary will, and as much as possible in the secondary will. And that way your beneficiaries get more money. So,
Mhm.
because that's the whole point of reducing the estate administration tax, the person passed away with a certain amount of assets. It is what it is. But by reducing this estate administration tax, more money is available to beneficiaries in their pockets, really, to receive as a gift. Yeah. So a lot of people are very interested in this topic, and that's the value of doing an estate plan.
Well, thank you so much for sharing. I know a lot of my clients specifically have asked as well. So thank you for your knowledge and your expertise. If anyone has any questions, please reach out to Raluca directly. And with that, please always like, comment, and share. Thank you.